Well, new research from Canstar reveals the amount of cash SmSF trustees hold as a proportion of overall investments has not significantly changed over the past 10 years. That's the constant chatter about the need for investors to get out of cash and into growth investments. For more, we're joined by Steve Michenbecker, Head of Research at Canstar. Steve, thanks so much for your time today.
Pleasure, Ingrid.
Can we start by just asking you, why do you think people are staying in cash?
Oh, look, it's interesting because there's been a lot of talk about the flow of funds into cash, and it's actually true. There is money flowing into cash in the self-managed super, which is the fastest growing part of superannuation. The reality is, though, that people have always had a fair chunk of their money into cash. It's always fluctuated in that 23 to 30% kind of range. So there's always been a lot of funds in self-managed superannuation funds in cash.
So it's not just a reaction of a nervous investor?
No, it's not. And we've seen over the last 2008 to 2012, right back to 2004. What's happened is that cash has pipped over direct shares, and people look at it and say, well, what's going on? People are getting out of the market. Now, actually, I don't think that's what we're seeing. I think what we're seeing is that the value of the direct shares people are holding has diminished as the market's diminished. And we've tracked both the All Ords and the proportion of direct shares in portfolios, and boy, they both do the same thing. They move together.
So why is it an issue then? Why are so many people, like the RBA governor and numerous experts, telling people to get out of cash?
Well, I don't think they're saying get out of cash, but I think they're saying, look, if you want to really prepare for your long-term retirement future, you actually have to be in some slightly high-risk investments. Now, it doesn't mean you've got to be silly about it, but you've got to put some of that cash that you might be holding into growth assets, because people are living longer. And if you're going to live 20 years beyond retirement, you actually need your investments to keep growing.
Well, that's the thing. Experts have been saying recently that an ageing population is a bit of a concern for the SmSF industry. What do you think about that?
Well, I think it's a concern for retirement incomes and lifestyles generally. There was a time when people retired at 65 and they might live only 5 or 6 years more. People are now living into their 80s, and that's 20 years beyond 65, and a lot are retiring earlier. You cannot afford to retire early and have all your money in cash and just gradually see it diminish. You'll end up on a pension.
Well, do you expect the weighting of cash to change at all now that we've seen interest rates falling?
Yeah, look, I think so. I think people will look at the current level of interest rates and they'll say things like, maybe I'm better off owning a bit of the bank rather than having my money in the bank. So I think we'll see that sort of impact coming through. But the other thing I think we will see is this move, as markets have improved, to actually put a little bit more money at risk in markets. And sure, we've seen a bit of a blip over the last month or two. Maybe it's just a blip, let's hope.
There's been a lot of talk lately about SmSF advice and how quality it is, and where people go for it and just how experienced those are giving the advice. Do you think this is going to change the industry in the long term? Look,
I think there needs to be a little bit of a tidy up, because you look at I was looking at some asset allocations just earlier today, and there are people who have $50,000 in a self-managed super fund, and really it's too low. You have no business having those low amounts in self-managed super. And you look at the cash allocation there, and 60% of it's in there, in self-managed super in cash. Now, you shouldn't be doing that because you're paying a couple of $1,000s a year to administer that. So you definitely should not be there with that sort of amount. You've got to have $250,000, and you do need to either have good advice or really be very financial literate yourself.
Now, I know you've released the Canstar's SmSF account star ratings.
Yes.
What did it show?
Look, people should go and have a look at the rating, because there are a lot of very good accounts in there, and I won't go and try to list them because there are about 10 or 15 5-star products. So I'll get myself confused if I try that. But there are some very good options and alternatives for your cash element in a self-managed super fund.
How is it put together, this list? How did you put it together?
Yeah, well, we do ratings of 90 or something different styles of financial products. And what we do is that we rate the features of the products and also the pricing of the products. So really, what sort of interest rate is available on the product. Now, of course, with an investment product, that's very, very high in the mix. But there are other bits and pieces around access and information and the like that's important also.
Okay, so who provides the best value? It looks like at the top of your list is ADCU.
Yeah, well, there's a list of winners, and they're all there. It's alphabetical, and
okay,
yeah,
that's alphabetical.
Yeah, exactly. So you know, it's a list of 12 or 15 products in there.
Now, the SMSF industry is certainly growing. The ATO says they're experiencing a surge in applications for SMSF in the months leading up to the end of financial year especially. Why is this?
Well, people are saying, you open up your superannuation return form and you look at it and you say, gee, I've gone backwards. Now, a lot of that's happened in the last 4 or 5 years, and people are saying, and what's more, I paid an MER of 1% for that. So you've paid 1% of your $200,000 or $300,000 worth of super into that, so it's cost you $2,000 or $3,000. Now, really, people are saying, well, I'm not happy with that. I think I can do just as well, and I think I can cut the cost. Yeah. So that's, I think, really the long and short of it. But they also say, look, I want a bit more control. You know, I want to be able to go into direct shares and make that the biggest part of my portfolio. I want to trade them as I choose. Maybe I want to put a property or two in there. So there are reasons of control and reasons of cost, and also reasons of disappointment that the professionals maybe haven't met my expectations.
How do you think the SMSF industry will look in, say, 10 years' time?
Look, it's growing so quickly that I don't think it's going to stop. And I think we're going to get just this continued surge of building in SMSF as people do become more financially literate and do want to take more control of their finances. So I think we'll see it continue to grow. I hope, though, that we'll see very small super balances not going that way, but going into the retail and industry funds that are available. And we rate those also, and there's some very good value options out there where you might only pay, you know, 0.3, 0.4, 0.5% of your balance compared to you know, $2,500 to manage your SMSF. I think the other thing that we'll see, and I hope we do see this, is a more packaged up SMSF so that it does drive the administration costs down. Yeah.
The government obviously increasing compulsory superannuation contributions. How will this impact the self-managed super fund industry?
Look, I think... sorry, hit me with the question again.
The government's increasing their superannuation, the compulsory superannuation contributions.
Yes.
Is this going to impact the self-managed
sorry.
super fund
Yes, of course it is, yeah. Because, I mean, more money flows into the existing super funds, the existing SMSFs. Yeah. So, yeah, we will see that continued growth. And it's going to accelerate because of that. Just as it will, though, in the total industry. I mean, it will also flow into the retail and industry funds that are out there.
All right, Steve Michenbecker, Head of Research at Canstar. Thanks for your time.
Thanks, Ingrid.